This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. Welcome to Bazaar Morning Call. This comes live from the CNBC-TV18 Motilal Oswal studio. I'm Latha Venkatesh. With me, my colleagues Prashant, back from his holiday, and Nigel, of course, has been with us. Well, just to bring you up to speed, we put behind a rather difficult Thursday, but we are heading to slightly negative cues from the global markets. Actually, we are in a situation where good news is bad news, and the good news was very strong private sector job creation in December. The data called ADP data is indicating that 235,000 jobs were created, and the expectation from analysts was just about 153,000. So it's extremely strong. And as if this was not enough, you also have very strong cues coming from the jobless claims. Now, this is claims filed by people who have unemployment, and the last week, the week to December 31, saw claims of just about 204,000, whereas the previous week it was 223,000. So the number of people who are asking for jobless claims appears to have declined. This is again indicating of a strong labor market. Doesn't quite gel with the 18,000 jobs that Amazon is willing to sacrifice, but clearly this is something the Fed will watch very closely. Now, the impact has been that obviously equity markets, you saw a 1% fall in all the Wall Street indexes. You saw bond yields rising. But my submission would be that the bad news or the worry that one is expecting from the non-farm payroll numbers, which will come today, that is government data. That's coming from the Labor Department of the United States. That news is perhaps already in the price. So what we are seeing actually now is Wall Street indexes, stock futures, showing a shade of green, as are Asian indexes. The possibility is that if there is any negative news coming in from the payroll numbers tomorrow, later today, that is perhaps in the price. I would take that as a likely positive for the markets. Prashant, what do you say?
I mean, it's pretty interesting, right? We're starting the year almost exactly in the same place where we were last year in terms of the worries, right? It's macro, it's global, it's central banks,
Absolutely.
and what they're likely to do. So just a couple of brief points. As you said, I mean, you've got the high-frequency data points, which are all pointing to a tight labor market in the US, right? I mean, you hear these headlines of large tech companies laying off people, but what is that as a percentage of the aggregate workforce? It's minuscule, right? So one has to keep that in perspective. So as Latha said, we have the claims and the ADP numbers, which were stronger than expected. We had the JOLTS number the day before, which was stronger. Monthly jobs data later today is crucial. That, of course, comes around US market opening. And that is the single biggest data point. Labor market tightness is what the Fed is watching. Actually the highlight, I mean, the jobs number later today will be the highlight. But so far, the highlight has been the FOMC minutes, right? Which we discussed yesterday. And the Fed is clearly saying that the market is getting this wrong still. It's leading to easier financial conditions, which is making our job, which is the Fed's job, more difficult. And in that sort of regard, market pricing of Fed's terminal rate has not moved since mid-October. If you go back and look at all of the legs of correction we've seen in US markets in 2022, each has been followed by the market pricing of Fed's terminal rate sort of moving a leg higher, from 2 to 2.5, 3 to 3.5, from 4 to 4.5, 4.75, etc. It's stuck at 4.75 since mid-October. And this could be a potential risk. If we see faster disinflation, it's possible, right? I mean, 2 data points and suddenly this worry is in the rearview mirror. But the fact is, if it does not play out like that, it's possible that market reprices this higher once again. And that is negative, as we've seen through the course of 2022, negative for risk assets. So that is one point, but it's like a possibility. Now, what's been happening here in India? You could look at day-to-day price action and not if you kind of sort of, for example, for the week since last Friday's close, the Indian market is down 0.5, 0.6% after all of the big moves we've seen day before yesterday, etc. But if you just extend that timeline a little bit, I think it kind of, if you zoom out a little bit, it helps you understand what's going on a little better. The big global underperformers of 2022, which is sort of markets like China, regions like Europe, they've come back pretty strongly in the last 2 months. you just go back and look at data from the 1st of November till date, right? I mean, I just looked at, did that exercise for the Hang Seng against the Nifty. The Hang Seng is up 47% from its lows in late October, and the Nifty is absolutely unchanged, some 45 point change in the last 2 months, a little over 2 months or so. So it's, there is a bit of pullback away from the big outperformer, which has been in India. And of course, I mean, there is money which is moving into markets like Europe, markets like China, etc. as well. Where do we come in here on the Nifty in terms of levels? Last 2 or 3 sessions, we've kind of again gone back to this pattern of lower highs and lower lows. Very simply put, if the market's got to come back and find its feet, that needs to be broken. The support for the Nifty comes in at about 17,961. What is that number? That number is the 61.8% retracement of the rally that we see, 500-point rally in 4 sessions that we saw from the 26th of December low to the 30th of December high. That is 17,961. We broke that yesterday, but we closed above it, so that naturally becomes the first. On further decline, yesterday's low comes into play, which is 17,892, and then the low that we saw on the 26th of December, which is 17,774. These are numbers to watch on the downside. On the way up, I mean, the Nifty has got short-term sort of hurdles in the region of 18,245 to about 18,265 kind of levels. But we are, I mean, so far the market kind of seems to have lost its mojo a little bit. Nigel will talk about fund flow, etc. over the last couple of sessions, and that is also clearly showing that maybe at the margin there is a little bit of kind of realignment which is happening out of the big outperformers, as I said, of 22. India has been a stark outperformer into some of the underperforming markets, and that is, I mean, I guess par for the course. If we are able to kind of hold these levels and not go down very, very sharply. Nigel, what are you watching?
Well, yesterday the call that we made was don't chase the morning opening. Yeah. Look for that intraday dip. We got maybe a deeper gash than expected. But the question is, did the weekly expiry in fact come to the rescue of the bulls? Because there was some covering that took place, and that's why we did see a bit of a bounce yesterday. So the bulls managed to dodge the bullet yesterday, at least for the time being. The 17,900 odd mark got protected. And the problem yesterday was your star performer, the Nifty Bank, that was underperforming yesterday. Though in the final hour of trade, it pulled back and it ended closer to a crucial technical level. It ended right on the 50 DMA odd. So that's going to be very, very important today. Was it a trend that is changing, or did the Nifty Bank just have an off day? For me, the positive though yesterday was the mid-cap outperformance. Even in a wobbly market, the mid-cap index gave you good returns. It was up close to around 0.5% odd. The flows, that's a bit of a problem pocket. The FIs have been selling for the last few sessions. 10 sessions, they sold 11,500 crores odd. And the bigger concern is normally look at the FI and the DI data together. Out of the last 8 sessions, 7 sessions, they have been net sellers. And if you take a look at the trend as well, that should come up for you at least for the last 5 sessions. What do the FIs do then in the F&O market? Well, we were talking about short covering. That played out yesterday. Some part of that, and that could be the reason why we bounced, because the cash market flows weren't encouraging. So yesterday we did experience some bit of short covering. 12,000 short contracts were closed out, and there was some long addition as well. And now the short positions have come down to around 59% on. So they're net short in the index. It's not a bad thing. They could be forced to cover out in case you get some bit of good news that comes out. Options data as well, 18,200 call, 18,300 call on, is seeing aggressive writing. So we could get a relief rally, but my sense is 18,250, 18,300 is going to be very difficult to get past on those levels. At lower levels on the put side, 17,600 put, 17,700 put, they opened up. There's buying being seen out there, premium at 20 to 30 rupees. But the 18,000 put, that saw addition, that has close to around 100 rupees of premium. You deduct that 100 rupees from around that 18,000 odd, and you get your crucial support, which coincides bang in with the technical levels on the Nifty itself. The Nifty 100 DMA comes in at around the 17,900 odd mark. Yesterday's low as well is out there. So the 17,800 to 17,900 mark, it's very, very crucial that the bulls defend that mark. The Nifty Bank, well, the crucial levels as well come up for you on the screen. We ended near the 50 DMA. Let's hope we end somewhere around that. Otherwise, there could be a bit of a slippy slide towards the 100 DMA. SGX Nifty suggesting a flattish start. Intraday dip will come today. We are seeing the SGX Nifty recover from the day's low. But that 17,900, 17,920 risk reward could favor the bulls like we saw yesterday. What else, Latha?
Yeah, it's quite possible because, at least the stock futures at the moment are indicating that the worst is behind in the global markets for the week. If that happens, I mean, if the stock futures continue to point to, the worst is behind and the non-farm payroll numbers are already in the price, then probably the shorts will want to cover more. But we will have to wait and see. Just a word, you were speaking about the North Asia and China outperformance.
Yeah.
This was something Morgan Stanley spoke about and said that India is too pricey. I think it was in end November and since then we have seen the outperformance of North Asian markets as well as China, more importantly China. Okay, just an important data point that will come in today, and that's the first advance estimates for the GDP of the current year from the NSO. It's an advance estimate. This is not a forecast like RBI and the banks make. This is actually an estimate, so it's got its own importance. But more importantly, only in this number you have to look at the nominal GDP, not so much the real GDP. Because the nominal GDP is, as per our poll, expected to have grown by 15.8%. That's largely because inflation was much higher than what we began with in the beginning of the year. Now, this 15.8% growth in nominal GDP will mean that the size of the economy in nominal terms will be about 269 trillion rupees. Now, why am I giving you this number? The budget on Feb 1st last year had estimated that the economy will grow by 11.1% nominal, and that size would have been 258. Now the economy is 269, so it's a much larger economy in nominal terms, and therefore you can have a higher fiscal deficit. Now, if you have a nominal GDP of 269 when you end this year, the government can assume a larger, probably some 10-11% for next year, so they have accordingly more fiscal deficit space. Now, all this math is only important to the extent that the budget process starts today. Once you get this number, is the nominal GDP this year 269, 265, 270, whatever the NSO tells you, based on that, the government will start working its numbers for the budget. That's why this becomes important. It's not market moving, but it's a very important arithmetic base for the budget preparations. And of course, we will discuss that at 5:30 when it is announced. The higher nominal GDP is going to allow a higher fiscal deficit this year, but that is all very well known. So we know that the deficit is going to overshoot, but it will be hopefully within 6.4 because of the higher numerator.
Okay, let's quickly run you through what is lined up on the first half hour of the show today. We'll get you updates from markets across the globe. And Ed Yardini, president at Yardini Research, will be with us to discuss the global trade setup. Later, our research team will bring you CNBC-TV18's list of top 10 stocks to watch out for the day. And around 8:30 this morning, we'll do a fundamental stock analysis with Prakash Devan of prakashdevan.in.
Okay. Now let's get to the equity call of the morning. We have a call coming from Victor Schwetz of Macquarie. Schwetz says absolute and relative performance of emerging markets in 2023 will critically depend on the macro outlook. He believes that the macro environment will be more supportive for EMs, offering an opportunity to meaningfully outperform developed markets for the first time in a decade. Although they maintain a negative secular long-term view over the next 12 months, emerging markets should be helped by falling inflation, lack of globally systemic fractures, central banks' ability to better balance growth versus inflation, and lower US dollar and higher yen. Victor Schwetz adds that performance of emerging markets should also be bolstered by their expectation that China will continue to re-rate, reflecting a powerful mix of reopening, fiscal and monetary stimulus, expected lower intensity of geopolitical and regulatory pressures, as well as lower valuation. All told, a good year possibly for Asia.
All right, Latha, we'll continue to get your opinion, but here is some live opinion now. Ed Yardini is president at Yardini Research. He's joining us now to take some questions. Ed, great to have you back.